Hey guys, welcome back to Retirement with Louie. I do these videos once a week on Sunday, a little departure from my normal videos, but I'm approaching retirement rapidly and I want to be the guy on the boat. Okay, now what could keep you from being that guy? Well, frankly, the stock market. Okay, let's take a look at E-Trade, and here is the NASDAQ over the last 10 years. Yeah, that's the NASDAQ. Look where we are. All right, now a common belief, and actually a very superior plan, in my opinion, is the bucket strategy. What I'm proposing today is one big bucket. Yeah, you got that right. I'm bucking the trend. And because I don't want to be around for the next downturn. Okay, if we take another hit back down from whatever, 16,000 back to 10,000 on the NASDAQ, and not as severe on the Dow or the S&P, I don't want that to mess around with that. All right, one of the tools I use is newretirement.com, and in this example here, you can see that retirement is funded at a 99% rate. All right, the reason this plan dips is because this person still has a mortgage, and when the mortgage pays off, then things get a lot better. But what is the rate of return that is assumed in this plan? 5%. At 5%, the plan works. So then I would ask you, why do you want to be in the market when your plan is already working at 5%? All right, one of the things that I'm doing right now in my one big bucket is I am heavily invested in short-term bonds and CDs. In the bucket strategy, you usually have short-term bonds and CDs in bucket one for living expenses during a market downturn. You often have a bucket two, which is a 60-40 or something like that stock bond portfolio. And then in bucket three, you would probably have the NASDAQ. And the combination of those would hopefully get you up to that 10% return that Dave Ramsey talks about. But it takes time, and it takes you being in the market for a long term to be able to enjoy the long-term returns. And I would ask you, why would we do that right now? Now, I know that in the bond category, let me get over to portfolios right here. All right, this is my E-Trade account, and these are actual investments in bonds. You will notice that the vast majority of the money, I do have a little gold in there, but the vast majority of the money is in short-term bonds. And here you can see that those bonds, if purchased at the right time, can actually create some income, right? Some capital gains if you choose to sell them, or some losses if you buy at the wrong time. But look at what they're generally paying. I'm not sure you can see this, but this is a short-term bond that was purchased below par. But here, JP Morgan Chase, this is a CD I picked up a month or two ago, paying 5.7% with no risk, short of JP Morgan's insolvency. Okay, that's always a risk. Here's an Intel bond paying 5.05. Here's a Walt Disney bond that has done really well. This is ultra long term, and I don't really recommend that, but this will be around for 20 years, earning 5.4%. And as a result, there's a nice capital gain on that bond. But the strategy would be to stay short, stay under 3 years in bonds or CDs, and ride this out with one big bucket. It's easy to do on E-Trade. You can just you can go to the bond category, and in here, in your self-directed IRA, that is, for you older guys. Or you younger people that have IRAs. Many people are in the 401ks. But you can see what the CDs are paying across time, and you can see what treasuries are paying across time, and you can see what corporate, AA, AAA, etc. are paying. I wouldn't get into the junk category with company bonds, and I would stay on the short leg of that. What I realized recently is that people in, let me get to the markets, people in those lifestyle funds, which 80% of my company is invested in, that is what is recommended. That is the conventional wisdom, is be in a lifestyle fund that's balanced with bonds. Okay? And let's get out 5 years and blow that up. Okay, so in that scenario, you clearly have risk in the stock market. I think there's extreme risk because I think recession is ahead. People in the real economy are seeing the downturn, whether it's services or products they sell or Tesla vehicles, you can see the downturn in the real economy. The government economy and government jobs are booming. So that is what is causing these numbers to escalate. But eventually that's going to stop, and we're going to be left with recession, in my opinion. Before we go any further, I should say I'm not a financial advisor. I'm not a registered advisor. I'm not, your advisor. I'm just showing you what I am doing and why I think one big bucket is the way to go right now. Okay? And if you were invested in TLT, or if you were in those lifestyle funds and you had a big chunk of long-term bonds in there, which is what they're supposed to do, they're supposed to buffer the pain. Well, you want to see some pain? This is what the 10 to 20 year bond has done over the last couple of years, and it is dramatic, and people lost a lot of money in those funds. In fact, the average return in a lifestyle fund in my company with reputable lifestyle funds has been 3%. 3% is what you've been getting, not the 20-30% that you hear people talk about, because they're in these balanced funds where you have bond risk and you have stock risk. And while interest rates are lower at the moment and the Fed is lowering rates, there could be another period after they get done with that where the recession is really obvious, and people will become worried about the $34 trillion in debt, and bonds could spike back up again, this time in excess of 5%. So in the long-term bonds, you could literally get murdered. But in the short-term bonds, let's get back over to bonds. In the short-term bonds, if you intend to hold those to maturity over 1, 2, 3 years, or a CD where you intend to hold to maturity to 1, 2, 3 years, or even 9-month treasuries or so forth, you don't really have any risk. Is there risk in this Walt Disney bond that goes out 20 years? Yes, there is. And at some point, I'll liquidate that. But the one big bucket strategy protects you from bond risk, it protects you from stock market risk, and it gives you yet another opportunity. And what is that opportunity? Let's go back to markets, U.S. markets. It gives you an opportunity to get back in at a lower price. All right, now I know financial advisors would just really disdain this video, but I'm talking to you people that are older and getting ready to do this. Why in the world, if your plan, and I do recommend newretirement.com, if your plan is going to work at 5%, why in the world would you want to be in this market right now, heading into potential recession, and if nothing else, at a pretty extreme high based on valuations and all other metrics, as manufacturing indicators are showing slowdown, etc. Again, it's the government that is creating jobs, and it is the government that is spending your tax dollars, creating $34 trillion in debt that will never be paid off, etc., etc. I can't see that being good for the stock market in the short term. But with this strategy, your powder is dry. You're waiting for a retracement back to, well, I don't think we'll see the COVID lows of 19,000, right, down from 38. But, we could easily retest 28,000, 30% lower from here. So if you follow this, and you want to do what I want to do, I have got a schedule of assumed actions that will happen if we get a downturn. And if we get a downturn, I'll be slowly moving money back into the market over time, over the downturn. The more extreme the downturn, the more lucrative this strategy can be. If we happen to get a big bust and we get down here to 25,000 or so, because remember, the market always overshoots. It's overshooting on the upside now, in my humble opinion, and it could overshoot on the downside. You start moving those bonds and CDs into stocks after the fall. Don't be, I've seen so many of these dips. Here we are in the dot-com crash. Looks like nothing right now, but it was big. Here we are in the great financial crisis. I think that was close to 50%. Not only your stock portfolio, but also your property values. And then we didn't have another dip until we had COVID, right? And here we are. So granted, over the long term, the market goes up. You want to be part of that. You don't want to be the guy that proves the retirement advisors right by staying out forever. You just don't want to do that. Just recognize that when you're in the market, let's get back to 3 years. When you're in the market, you carry all the risk to the downside, and if your returns drop to from 3%, which is what most people are getting. Keep in mind, they've got a broad basket of stocks in those lifestyle funds, and they've got international stocks. China is literally falling apart as we speak. So you'd want to be probably in India, not China. But if you're in those lifestyle funds, you've got to be ready for a pullback. And if that pullback takes you to -5, -10, -20, your bucket one of all cash may not be enough. And if bonds disappoint again in your bucket two will get decimated as well. And then your bucket three will be in the ER. Why do you, if you're 63, 65, older, why do you want to be in the market right now? I don't. So I'm saying one big bucket, watch it, and then act opportunistically with your safe investments to move them into stocks when the time is right. If I'm wrong, well, then the market goes higher and I'm wrong, and you are still out here. Okay? There's literally no way that the marketplace can ruin my sailboat trip here. And if you need a higher return on your stocks to fund your retirement plan and you're not at 99%, well, you may have other considerations. But I'm saying if you've already won the race, why don't you stop running? Okay, I didn't make that up, others did. But I see everybody recommending the bucket strategy. I see everybody recommending the 60/40 portfolio, which has done horribly over the last couple of years. And I see, I like the bucket strategy. I want to be in a bucket strategy when the timing is right. Right now, I'm in the one big bucket strategy. So what do you think? What do you think about that plan? Tell me where I'm wrong. I don't want to be greedy in my 60s, right? I don't need the 10% return. I got the 5 handled. I've had the 5 handled for a couple of years, doing better than the lifestyle funds that they recommended. But what's wrong with that? Why can't you be ultra conservative and ultra safe, staying in bonds and CDs on the short term? Now, as I said to my financial advisor a couple of years ago, you've got to be crazy putting bonds in your portfolio when rates are 0. What in the heck is going to be, the upside to that? Well, there wasn't. There was nothing but downside. And they were wrong. All the professionals were wrong. 60/40, 60/40, 60/40. That's all they say. It's easy. Stay in the market. Even if grandma's, 92, stay in the market. Well, I don't believe in that. If you do want to balance your stock portfolio, think about gold. Because that's the other thing I said to the financial advisor is, well, I don't want to balance my stock portfolio with bonds. I want to balance it with the new bond. What is the new bond? Gold. Okay, better to have physical than a paper ETF. But look what gold's been doing over the same time. You wish you had been invested with gold instead of bonds in the past. Now, he said to me, you know what? We have a fund for you. We have a gold fund in our 401k plan. And I said, yippee, I like that. And I even invested in it. And you know what it was? It was a portfolio of gold miners. It wasn't gold. Okay, gold miners are not gold. Gold miners are stocks, and they're going to perform differently than gold itself. And that was premature to get into that. I lost some money, I got out, and then I realized, these financial advisors, they're all taught to say the same thing, think the same thing, and advise you in the same way, unless you've got a really unique one. And so I'd like you to consider my one bucket strategy and let me know where you think my risk is, other than sitting out some appreciation, which I don't need to fund my plan. Okay, again, I'm not a financial advisor. I'm not making financial recommendations, but I am telling you exactly what I'm doing at this particular time. And, if you're rolling the dice with your retirement plan, then, there could be sharks in that water. All right, guys, what are your thoughts? And thank you for watching another video. I do appreciate you tuning in to these retirement videos. I'm just trying to get these going, and hopefully I have something new and different for you to consider. All right, this is Louie out. Bye now.